Welcome to Every Dollar Counts with Josh and Jay, a shot of true serum for your investment and insurance questions. I'm Josh Knoll, the owner of Gulf Coast Financial Advisors, and I'm joined by my co-host, Mr. Jay Stubbs, director of the Gulf Coast for First Protective. We are brought to you on the Prime Capital Investment Advisors podcast network. Jay, buddy, how you doing?
Josh, I'm doing great. It's good to be with you in studio and talking about some of these very important topics on qualified planning, specific to 401k plans, and some other aspects that agents, advisors, and clients need to know about this stuff.
Yeah, I agree. And I want to thank you for joining me today because we have a very special episode. It's dedicated specifically to 401k plan sponsors and business owners. So, Jay, I recently completed a qualified plan educational series called the 401k Project, and it featured the contributions of Matthew Eichmann. He's the National Retirement Practice Leader for Prime Capital Investment Advisors and Qualified Plan Advisors. For those of y'all that may not be familiar with those two companies, my company, Gulf Coast Financial Advisors, is part of the Prime Capital's network of independent advisors, which really gives me the support of a multi-billion-dollar investment company, but still provides for independence and ownership of my practice.
That's a great resource for you, Josh. Amazing resource, and I'm so thankful you've got it to bring to your clientele.
To be quite honest, Jay, it allows me to compete with the big boys, because I can be local, I can be independent, I can have ownership of my book, but I have the resources, many team members at my disposal that can help me come in and really service and work with my clients to the highest level. So, Jay, Matthew and I capped off our series with a webinar where we discussed the most important items that plan sponsors need to tackle in 2020. So what I did is I selected a few important clips from that webinar that you and I are going to provide some context to. Now, listeners, I want you to note that Matthew Eichmann has experience as a risk attorney, many years of experience. So it's very detailed and very relevant information, particularly to the plan sponsors and business owners listening to our podcast. I will go even so far as to say this, Jay. As you know, I'm a lifelong basketball junkie.
That's right.
And as you also know, and many people that meet me out in public know, I'm not what you would call tall.
No, you're challenged vertically.
Challenged vertically, yeah. So anytime that I would step on the basketball court over the years, I had to kind of do a little mental exercise to tell myself, well, I belonged here. I know these guys are bigger, faster, and stronger, but I'll find a way. And I did over the years. Well, the reason I bring that up is because, stepping on the court, Matthew Eichmann in this space was kind of like stepping on the court with Michael Jordan. I mean, you're talking about the top of the top in these items. So I think the listeners, as you listen to what Matthew has to say and my feedback, you're really seeing someone that has crafted his experience and his art to the highest level. And I highly encourage you to take a listen to what he has to say.
And there's some urgency to the messaging and the content that we're about to give you all. So listen, share. Listen again and make sure that you're understanding all of the components that you're going to hear.
Yeah, these are items that plan sponsors need to tackle now, not next year or the following year. These are things that are important right now. This episode will discuss the impact of the CARES Act on qualified plans, particularly issues that plan sponsors face with opting in or opting out of the CARES Act, and then the special loan provisions that were offered to plan participants. So, Jay, I got a question for you. I mean, with your role servicing advisors like me along the Gulf Coast, what have you seen? What's been your experience so far with the CARES Act?
Well, it originally said we're going to help people that lost their jobs, and then they updated. We found out from Treasury.gov and through other articles that everything is going to be updated. If your income was reduced or if you had a new job delay starting, you could access your 401k or qualified monies. Even if your spouse's income was impacted as a result of the pandemic, they let you access it. So the Coronavirus Aid, Relief, and Economic Security Act, CARES Act, is designed to help people get money. So in my opinion, advisors need to know, hey, this is something that's important. I may have clients calling me. It may not be today or it may not be have happened already, but it could happen in the next foreseeable future. And they need to be able to advise properly, and they need to be able to mark their calendars and follow up on the payback, because these people who can take a penalty-free withdrawal and help maybe shore up that checking or that savings account, they're going to have the opportunity to pay that back. They have a three-year time frame to do so. Advisors need to mark their calendars on that.
Well, that's a great point, Jay. So without further ado, let's hear our clip from the webinar discussion between Matthew Eichmann and myself. But before we dive into that, let's have our friends from Sloth Racer kick us off.
Let's work through our roadmap in this order, Josh. And the place I want to start is a place that's of great interest to a lot of plan sponsors. And we want to put it right up front in part because the window to care about this and the window to do something about it is closing pretty quickly, and that's the CARES Act. So if we put ourselves back into that situation when the CARES Act came about, we can remember just how quickly and how furiously that all happened. Remember being back in March and everybody's world was kind of flipped on its head, and we didn't know what was going on and what end was up and what end was down. And we really were somewhat surprised that both sides of the aisle were able to reach across the aisle and make something happen so quickly, to be able to provide relief to Americans. But as you might recall back in March, because they were working so quickly, because there was such a sense of urgency, these CARES Act provisions came about before we really even knew a lot of the answers. So what we want to work through here is we want to talk about, first of all, what approach did record keepers take? Just a real quick reminder of what the key CARES Act provisions are, and then let's give a roadmap to plan sponsors to follow out over the rest of this year, kind of some best practices or some action steps for them to take. So as a starting point, does everybody remember when we were back in late March or early April, and there was this big debate about whether a record keeper was going to say to you, plan sponsor, you are automatically adopting all of these CARES Act provisions unless you opt out, or said to you, these provisions will not apply unless you opt into those. So that was the big issue that we faced, and we face that yet today, even in late September and as we move in through the rest of the year. Which approach did your record keeper take? And so we need plan sponsors to work through this framework and say, wait a minute, have we already made an election, or has a deemed election been made for us? And if so, what did we select? And if not, do we have a deadline coming up quickly to make a final decision? And actually, plan sponsors who did not put any provisions into place or did not put some of those into place might be saying, do we still have time to change our mind now? And as a reminder, the CARES Act really brings in these key provisions that were designed to be able to get more money into Americans' hands more quickly. And the first of those is the ability to defer loan repayments. So participant takes out a loan from a 401k plan. There's a schedule on which that individual must pay it back. A certain amount comes out of payroll every payroll period, and that goes to pay down the loan. Well, the CARES Act said that starting in late March for the rest of the year, employees who had those loans could get through the process by not having to make a repayment for the rest of the year. Now, of course, it didn't make the loan go away. It didn't make the repayment obligation go away entirely, but it allowed those employees to defer that repayment obligation to next year, to 2021. So a lot of plan sponsors have already made the decision, or they had it made for them. And so the real question for them is, what do we have in place? And have we communicated well with employees? And do we understand how this will work when we get into January? What's going to happen in 2021 and beyond? That's ultimately the question for plan sponsors, is to have a better handle on how will those repayment obligations be reamortized. And you can think through that in your head a little bit, right? Will the higher repayments be owed with the first payroll period in January? Will it be the second? Will we wait till April? Will there be a higher repayment owed in April and another one in May and another one in June and all the way through December? It will vary based upon the record keeper. So that's an important step for plan sponsors to take. And then the next is to be aware of how this increased loan ceiling worked. Now, a lot of plan sponsors have already made their final decision on this. And the window to be able to do this is fast closing. But ultimately, the opportunity here for participants was to be able to take out a bigger loan than they ever could before. So if we have a plan sponsor listening to us right now, and Josh, as we want to try to be timely and be practical, the critical question for them is, do we have participants coming to us right now saying, I need to be able to take out a larger loan under the CARES Act? If the answer is no, then they don't need to listen to the next 45 seconds. If the answer is yes, then the next question is, if we were to increase the loan ceiling, would our plan's terms allow that participant to take that larger loan? Or do we have a limit on the number of loans that participant has already exhausted, and therefore he or she may not be able to take the loan? That's the critical decision tree approach for plan sponsors with regard to the larger plan loan ceiling. And then finally, and this was the big one, this one got all the headlines, the ability to take $100,000 coronavirus-related distribution from your retirement plan. Sound kind of like free money, and there's all sorts of positive tax advantages to doing that. You can spread out the tax liability over 3 years. You can forego or avoid the 10% early penalty tax that might be applicable. And here was the golden nugget. You can repay it back into the plan. Well, we should all ask ourselves, do the people who most likely needed to very quickly get their hands on $100,000, the ones most likely to want to put that back into the plan really quickly? Probably not. So it's critical for employers, if you already put this into place, make sure that the 1099 reporting obligations are being met by you and or your record keeper and or your TPA. If you haven't put it into place, get a sense for whether your employees are still coming to you and saying, hey, we need this. Because even though I made light of whether employees will really pay this back, this is a serious issue. We have people with real struggles that they're facing. We have people who do need access to this money. And if that's the case, we want employers to know, ultimately, don't worry about what every other employer across the country is doing. Don't worry about the percentages. Hey, what percentage of employers have done this? The real question there is, what do our people need? And then finally, a couple of reminders for employers. And I know there's a lot of text on the screen in front of us, so I want to be really quick. In the CARES Act, the ability to take any of these types of special distributions or take advantage of the loan provisions, it depended upon an eligibility trigger. The participant had to test positive for COVID-19. The participant had to experience the adverse financial consequence as a result of being quarantined or furloughed or laid off. It had to be the participant in each of those situations. Well, that was expanded in this IRS notice that was put out over the summer of 2020, where now there's a much broader array of triggers. And I tell you, this is incredibly important. I even ran into an ERISA attorney 2 weeks ago who told a client of mine, hey, you cannot allow that distribution because it was your spouse of your employee who lost her job, and that's not a trigger. And I was able to say, wait a minute, the IRS told us in June that you absolutely can permit that under the terms of your plans. So it's important for employers to become comfortable with those triggers. And then it's also really important to recognize plan amendment for any of these changes is not required to be adopted until the end of 2022. That's really cool, right? That's nice to know, hey, there's no rush. We don't have to get that done. However, we have to make sure that what we're doing now eventually matches up with what's in the amendment. So employers do need to pay attention to the details and do need to make sure that they understand what have they adopted, what have they not adopted, or what has been adopted in their place. And then my final point here, Josh, is that the IRS wanted to make this really easy. So when it talked with Congress about how this would work, it recommended, and Congress agreed, that there could be merely a self-certification process. So employee comes to you, the employer, and says, I meet one of these triggers. Therefore, I should be able to take a coronavirus-related distribution. Well, in normal times, employers are saying, wait a minute, do I need to check? Do I need to confirm that that participant tested positive for COVID-19? And the CARES Act said, no. Self-certification is all that matters. And the IRS gave us this follow-up guidance, and it said, absolutely, we want you, the employer, to not have an obligation to investigate. Now, if you have reason to know or reason to believe that there's a misrepresentation, then you investigate. But if that's not the case, we want a structure that allows an employer to rely upon that self-certification. Once you get through to that point in the process, Josh, the employer is in a position where it can take the employee's word and go ahead and process the distribution or the higher loan.
So plan sponsors and business owners, what you just heard was a discussion between Matthew Eichmann and myself related to the big items that plan sponsors need to tackle in 2020. I do believe this is a great representation of the experience and expertise that Gulf Coast Financial Advisors brings to the table, and really that's enhanced by the combination of the significant resources available to me through Qualified Plan Advisors. So if you're a plan sponsor or business owner located along the Gulf Coast and you'd like to have a conversation about these issues, you can call us at 251-327-2124, or you can always visit my website at gulfcoastfa.com. That's FA as in financial advisor.
Josh, you've got some good material on your website that business owners and plan participants can go and look into, can't you?
I do, Jay. And specific to this topic, I actually have a dedicated landing page called the 401k Forum, where you're going to find this information, related podcast articles. It's obviously going to be very CARES Act and COVID related, but that's what should be on top of mind for plan sponsors right now. So I really encourage you all to visit that website, take time to listen to the full webinar, and dive into the other materials that we have there. And then also, lastly, to all you independent and semi-independent advisors and agents out there, hearing the value that Jay Stubbs could bring to your practice, you can always find him at jstubbs.com. That's JAYSTUBBS.com. Jay, any final thoughts?
Josh, this webinar that you did, you and Matthew did, is fantastic content. I really enjoyed listening to it and taking a lot of notes and just soaking up all the information. A lot of change, especially in retirement planning in 2020. When you look at the CARES Act and the Secure Act and all of the details that we did in these episodes, really, really important information for people to soak up.
I think it's fair to say that 2020 will go down not only as in society as a time of unprecedented change, but you really had a lot of things come to a head as it relates to qualified plans, particularly 401ks. So yes, highly encourage, agree with you, Jay, highly encourage people, especially if you are someone that sponsors a plan or is a business owner offering a 401k or are thinking about offering a 401k plan to your employees. Take the time, take a listen. You'll be much better educated. Well, Jay, before we go, we got to do quick housekeeping for compliance.
Yes, please do.
Yep. Jay Stubbs and First Protective are not affiliated with Prime Capital Investment Advisors, Qualified Plan Advisors, or Gulf Coast Financial Advisors. And Josh Knoll and Gulf Coast Financial Advisors are not affiliated with First Protective. Jay, I want to thank many thanks to our producer, Johnny Gwynn of Deep Fried Studios. I want to thank you, obviously. And then a special thanks to Matthew Eichmann for taking the time to provide so much knowledge to my network. He really put a lot of time and effort into this, and it shows. And then finally, a huge shout out to all y'all that have joined Jay and I in this journey. To those of you all joining us now, check out our previous episodes. You're going to be pleasantly surprised. Do you like the show? Do me a favor. Please subscribe on the Apple Podcast app or wherever you find your favorite podcasts. And while you're there, you would be doing us a huge favor if you would rate and review the show. It helps other listeners like you find us. Lastly, you like the show music? Go check out slothracerband.com. That's slothracerband.com. And they're going to take us home now. This has been Every Dollar Counts with Josh and Jay. Advisory services offered through Prime Capital Investment Advisors, LLC, PCIA, a federally registered investment advisor. PCIA, doing business as Prime Capital Wealth Management, PCWM, and Qualified Plan Advisors, QPA. Gulf Coast Financial Advisors is independent of Prime Capital Advisors. Information presented for educational purposes only, is not an offer or solicitation for the sale or purchase of any securities. All investments involve risk, and unless otherwise stated, be sure to consult a tax professional before implementing any tax or investment strategies.